Okay, so let's do a quick recap first of all, before we start the new area. We started with chapter number 2, investment appraisal. And you know that investment appraisal wants to see the attractiveness of an investment proposal. And the attractiveness will be on the basis of return and the risk. So we started with the payback period. And in payback period, we saw that how quickly can you actually get your invested money back. And after that, we will start with accounting rate of return, right? Now, just a quick reminder for you guys, those of you who are not consulting the book along with the notes, I would say that you should actually see it from the book also. I mean, when we are covering a lecture within the class, you should be actually referring to the book also, right? Okay, so you got the answers, right? I hope that most of you already got 3.8 years for question 2.2 and 5.14 years for question 2.4. If there is anyone in the class who has got a different answer, please do let me know. Okay, so we will do the question in spreadsheet first. Today is 12th, so I'll call this particular sheet 12th, right? And every day when we will actually do questions within this workbook, I'll be sharing you the whole workbook, right? So you can actually save it also. Now your exam spreadsheet is actually slightly different than this particular spreadsheet, but it's not going to be very different, right? You can say that your exam spreadsheet is going to be like a basic kind of Excel, right? So we will not use any function. We will not use any function that is not actually available in spreadsheet. Thanks for correcting me. Let me change this. It's 20th. Okay, so let's see the question. First of all, we'll do the same question that we did yesterday. So question 2.1, if you can see here, question 2.1, a project is expected to have the following cash flows. So it's 1900, 300, 500, 600, 800, and 500, and you have to calculate the answer in spreadsheet. Now it will be actually much easier to do it in spreadsheet rather than on the paper. So it's question 2.1. I'll have a column for years, then I'll have cash flow, and then I'll have the cumulative cash flows, right? So we'll start with year 0, and the cash flow is 1900. And we have 1900 over here also. And then for year 1, 2, 3, let me check the figures from the notes. So it's 1, 2, 3, 4, and 5. So it's 300, and then you have 500, and then you have 600, 800, and 500, right? So instead of using a bracket, I'll actually use a negative sign. This minus 1900, or okay, minus 1900. Okay. Okay, so you have minus 1900 and then you got 300 after that. Now what you can do is you can put an equal sign here, and then you can add 1900 with 300. Can you say is equal to D4, which means 1900, and then you're going to add 300, which will actually give you 1600. In the next cell, what you can do is you can again put an equal sign, and you can again say this cell 1600 minus 1600 plus the 500. In the next cell again, you can do the same thing, 1100 minus plus 600, and then again 500 minus plus 800. Now, of course, you can do that, but of course, it's going to take a lot of time, and you don't want to waste time in the exam. In order to do it quickly, what you can do is, in the first cell, it will be minus 1900 plus 300, and then you can simply drag it and apply it on the rest of the cells. So can you see, after 1 year, we have 1600 left. After 2 years, we have 1100 left. After 3 years, we have 500 left. And in the 4th year, we have plus 300. So the payback period is somewhere between year 3 and year 4. How much exactly is that? We can actually do it in the working. So I'll call it working 1. And then I'll say is equal to this cell divided by this cell, which means how much do you need? 500. How much do you expect next year? 800. So this will give you 0.625. Of course, you can ignore the negative sign, right? So how much do you need more? 500. How much do you expect? 800. And then you can ignore the negative sign, right? And then you can simply say 3.625 years. So payback period will be 3.625 years. Right? Payback period is 3.625. 3 years complete, and the 4th year will be not exactly complete, so it will be 0.635 of the 4th year, right? And if you want to calculate that in months and years, so payback will be, we can see that it's 3 years, and then how many months? You would say 0.625 multiplied by 12. So this will give you 7.5 months, right? So it's 3 years and 7.5 months. All right. Okay, so that's how you do it in Excel, right? It's very simple, right? It's not going to take more than 1 minute, right? You simply have to, put the formula in the second year, in the first year, and then after that you can simply drag it. And for the working, you would say, how much do you need? 500, you need more. And how much do you expect next year? 800. So 500 divided by 800 will give you that how much of the 4th year will it take to get to the zero cash flows, which means that whatever you have invested, you actually got it back, right? And then you have 3 years complete. Okay, so of course, for those of you who are using spreadsheet for the first time, you may find it slightly difficult because that's your first time. But of course, we will be doing many questions in our class. So in a couple of weeks' time, even if you're new, you will be fine with the calculation, right? Okay, so that was payback period. And now we will start accounting rate of return or return on capital employed, right? Now for your exam, these two words will be used interchangeably by the examiner, which means that for your exam, ARR and return on capital employed will be considered as the same thing, but it's not exactly the same. They are slightly different. As I told you yesterday, that paper F9 is all related to the future, right? It has nothing to do with the past, right? But when you say return on capital employed, that means it's about the past. If you remember the formula for return on capital employed, who is going to give me the formula for return on capital employed? Or some people like to call it Rocky, right? What's the formula for return on capital employed? Anyone? The formula was your operating profit or your PBIT divided by capital employed. So what does that mean? How much percentage profit you had when you employed the capital? How much profit you had? Well, that's a sign of past, right? So basically when I'm saying you had, it means the past. But we said F9 is more about the future, right? So that means it's not investment appraisal, it's performance appraisal. You don't do investment appraisal for the past. You want to see the performance in the past. So this is performance appraisal. Right? Now, what is ARR? If you do the same thing for the future capital employed and the future profits, that's what we call ARR, right? And that's why, because the formula is slightly different, of course, like you'll have the future profits and the future capital employed, right? So the formula will be different for ARR. But as we said, F9 is all about the future. So even if your examiner is saying return on capital employed, he basically means ARR, right? Now, in your notes, I've actually made a few points. If you can see here, right? ARR and return on capital employed. ARR and return on capital employed are used interchangeably for investment appraisal purposes in exams, but are slightly different conceptually, right? Return on capital employed, as we said, is for the past, so it is done for performance appraisal. Investment appraisal is for the future, and that's why we use ARR. For return on capital employed, as you have mentioned, we use last year's PBIT, last year's profit before interest and tax, or some people like to call it EBIT, earning before interest and tax. When it comes to the future, so of course your investment will not be just for 1 year. It can be, let's say, more than 1 year, let's say 5 or 6 or 7 years. So what do you do then? Well, you calculate the same profit, but the average profit for 7 years. So the average profit for 7 years before interest and tax. Return on capital employed is giving you past information. ARR, or the accounting rate of return, is giving you the future information. The formula for return on capital employed, as we have mentioned above, is PBIT divided by capital employed. And for ARR will be average PBIT, right? Because it's for more than 1 year, so average PBIT divided by initial capital cost, and it can be also on the basis of right? So it can be on the basis of initial capital cost, and it can be on the basis of average capital cost. Is it a choice for you guys in your exam? No. Your examiner never gives you any choice, right? So this is actually dependent on the examiner, that how the examiner want to test you. So examiner will be telling you to calculate ARR on the basis of initial capital cost or on the basis of average capital cost, right? So they are slightly different conceptually, but it doesn't mean that if your examiner is asking you to calculate return on capital employed, you're going to tell the examiner that, well, they are slightly different, and then you have to explain. No. If your examiner is asking you to calculate ARR, it means your examiner wants you to calculate. If your examiner is asking you to calculate return on capital employed, basically, examiner is saying to calculate ARR. That will be the same thing for investment appraisal, right? Is it clear to everyone? Is everyone clear on this? Now, on the next page, if you can see, there are a few formulas. Okay, so we have a few formulas here, right? And as we said, ARR can be on the basis of initial capital cost, and it can be on the basis of average capital employed, right? So we are actually given two formulas here, right? It says return on capital employed, we'll say ARR or return on capital employed are the same thing. So the two formulas are that we have just mentioned on the previous page: average annual profit before interest and tax, or we said average PBIT, divided by initial capital cost, or average PBIT divided by average capital cost, right? So these are the two formulas for ARR, or return on capital employed, that you have to remember. Now, if you are not given the average capital investment, then how do you calculate it? Here is the formula for average capital investment, right? The average capital investment, which will be the initial capital investment. So let's say if you're starting a project and let's say you have spent initially 1 million, right? So initial capital investment, and at the end of the project, let's say the investment has a scrap value of 100,000. So with 1 million, you have to add 100,000. So let's say you started your business with 1 million investment, and in the end, the value of that investment is 100,000, right? So you'll add these two together divided by 2, right? So you have the value at the start of the investment and the value of the end of the investment divided by 2, and that will be your average investment, right? So if your examiner wants you to calculate the return on capital employed on average basis, then you have to calculate the average capital investment. The next thing your examiner can consider, that it's accounting rate of return, right? Now we are saying profits. If you remember, in payback period, we were considering cash flows. So if you are given the profits, your examiner may give you the cash flow figures, and then he may want you to calculate the profits. So he may want you to convert the cash flows to the profits. So if that is the case, then the formula would be profit is equal to cash flow minus depreciation. So if you're given the cash flows, from the cash flows, you will deduct depreciation and you'll get the profit figure. Can you see here in the formula, we have to calculate profit. So if we are given the cash flows, we can calculate it. Let's say, for example, you are also not given the depreciation figure, because profit is cash flow minus depreciation. So if you're not given the depreciation figure, that's how you calculate it. Initial investment minus the scrap value. You might be thinking, well, that's not what we used to do in financial accounting, because in financial accounting, you were calculating the depreciation for 1 year. And now you are calculating the depreciation for the whole project. So let's say you have this asset. Let's say this is the asset, and you bought the asset for 100,000, right? And after 7 years, let's say you can sell it for scrap value of 20,000. So where is the rest of the money gone? Or where is the rest of the asset gone? You can recover the 20,000, but the rest of it is depreciation. So it's 80,000, right? So initial investment minus the scrap value. That's how you calculate it, right? Is everyone clear with the formulas, right? Everyone clear with the formulas? Any issues, anything? So now a quick one, if you can see, a quick recap. Now you have two formulas for ARR, or return on capital employed. Number one, it can be on the basis of initial capital cost, so average annual profit by initial capital cost. It can be on the basis of average investment, so average PBIT divided by average capital investment. If you are not given the average investment, that's how you calculate the average investment, right? If you're not given profits, and let's say you're given the cash flows, that's how you convert cash flow into profits. if you are not given the depreciation figure, that's how you calculate the depreciation figure, right? Now, we will do a question on this, and I hope it will make more sense after that. Now, it says, question 2.5, a project involves immediate purchase of an item of plant costing 110,000. So what is this? Initial investment, right? So this is your initial investment, right? So this is the project. The project is actually the investment, and if you have to invest in the project, that's how much you invest. It would generate annual cash flows. So every year the cash flows will be 24,400 for 5 years, right? So 24,400, 24,400, 24,400, 24,400, and 24,400. For 5 years, you're going to have these cash flows. What did I tell you? Your examiner may give you cash flows, and then you have to convert cash flows into profits. And you are given the cash flows here. Starting in year 1, which means next year, or at the end of the year. So starting in year 1, the plant purchased would have a scrap value of 10,000 in 5 years. So the life of the project is 5 years, and the scrap value is 10,000. And when the project terminates, depreciation is on straight line basis. Okay. So that will be the scrap value when the project terminates, and depreciation is on straight line basis. You see, it's not important if the depreciation is on straight line basis or reducing balance method, whatever is the depreciation, because we are not calculating depreciation for 1 year. We are calculating the total depreciation, right? So first of all, the requirement. So as I told you, that we can calculate ARR on the basis of initial capital cost and on the basis of average capital investment. So we'll first do it on the basis of initial capital cost, right? So question 2.5, part A, I'll say ARR or return on capital employed, initial capital cost basis, right? So let's write down the formula. First of all, we said for initial capital cost, it's average PBIT by initial investment, right? So do we have the average PBIT? No, we don't have it. Do we have initial capital investment? Yes, we do have. How much is the initial investment? 110,000. Right? What about average PBIT? We'll calculate it in working 1, and then we are going to have our answer here, right? So let's do it. Average PBIT, right? PBIT is the profit, and we don't have the profit, but we do have the cash flows. So we can use this formula to convert the cash flows into profit. How do you do it? Cash flow is equal to, profit is equal to cash flow minus depreciation. So first we'll calculate the profit, and then we will calculate the average profit. So total profit is equal to cash flow minus depreciation. Do we have the cash flows? Yes, but that's cash flow for 1 year. And there are 5 years in total. So 24,400 multiplied by 5 years. That will be the cash flow. What about depreciation? Are we given depreciation? Again, we are not given the depreciation, but it says scrap value is 10,000 and initial investment is 110,000. And the formula said initial investment minus the scrap value will be 110,000 minus 10,000. So that will be 100,000. Right? So depreciation is initial investment minus the scrap value. So this is scrap value and this is investment, right? So this will give us 100,000. So the total profit figure will be 24,400 multiplied by 5, and this will be 100,000. So minus 100,000, so which will be 22,000. So the total profit is 22. Yes, the total profit is 22,000. And now we have to calculate average profit. So average profit will be your total profit divided by number of years. And there are 5 years. So the average profit will be 4,400. Right? Is it clear to everyone? Please let me know if it is not clear. Okay, so the average profit is 4,400. And we already have the initial capital investment. So 4,400 divided by 110,000 will give you 0.04, which means 4%, right? So 4% is the answer, right? So average capital, initial capital cost on the basis of initial capital cost, when you calculate ARR, that's how you do it, right? Now we will do the second requirement. So let's do the second requirement now. The second requirement is that you calculate again ARR, but this time not on the basis of initial capital cost. This time we will do it on the basis of average capital investment, right? So if you refer to the formula once again, you see in both these formulas, of course, the numerator is not different. Numerator for both of them is the same. Average annual profit before interest and tax, average annual profit before interest and tax. The only thing different is the denominator. So we can take this figure from the previous question and then we can calculate average capital investment, right? On the basis of initial capital plus the scrap value divided by 2. So part B, ARR or ROCE, average investment basis. So ARR, as we said, we will get the figures from the working one above or from the question, which is 4,400. And now the average capital investment, right? We will do it in working 2, right? Which is initial investment 110,000 plus scrap value, which is 10,000 divided by 2, and that will be equal to 60,000. So it's 4,400 divided by 60,000, which should give us 7.33%. Easy, isn't it? Quite easy. So that was ARR. Now we have another question, which will be actually your homework question, but I want you guys to do it right now. I want you guys to do it right now. Let's see who is going to do it first, right? Okay, so question 2.6, this is the homework, but of course, I want you to do it right now. So it says, a project requires an initial investment of 800,000. So here is the initial investment. And then again, you're given the cash flows. But in the previous question, you were given cash flows per annum. But for this one, the cash flows are different every year, right? So of course you cannot just multiply it with something. You have to add all of them. So 100 plus 200 plus 400 plus 400 plus 300 plus 200 plus 150 will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So that will be 1750. So the cash flows in total are 1750. In addition, at the end of the 7 years, the project assets initially purchased will be sold for 100,000. So here is the scrap value. So you have the initial investment, you have the cash flows that need to be converted into profits, and you have the scrap value, right? Can you quickly do it on the basis of initial capital cost and average capital investment? Guys, you're champions. I'm quite sure you can actually do it within 3 minutes. Let's see who is going to do it first. Let's start. Okay, good one. So all of you actually got the right answer, right? That's how you do it. If someone has not done it, please let me know after the class, or you try it at home once again, right? It should be fine, right? So accounting rate of return. So here is the project. And let's say the project have 5, 6, or 7 years of life. And if you want to see if it is generating enough return for you in percentage, that's what we call ARR, or the return on capital employed. Now, the answer for the first one, for example, is 18.75. So what conclusion are you going to get from this? Are you going to invest in this project? Do you think you should invest or not? What do you think? You think you should invest or you should not invest? Because of course we use ARR, or return on capital employed, for decision making. So what are you going to conclude? Should we invest or should we not invest? Yes, it's based on the company's policy. So accounting rate of return, like payback period, as we said in the payback period, it depends on the company's policy, that what is actually acceptable to the company, right? So you'll have a target payback period, and in the same way you're going to have a target accounting rate of return, or return on capital employed, on the basis of which you are going to conclude if you should invest or not. So let's say if the company has a policy that the company will invest in all the projects with ARR greater than 15%. So yes, we are going to invest in this project, or on the average basis, for example, any ARR more than 33.33%, right? So for ARR, of course, it is dependent on the company's policy, that what decision you are going to take, right? Now, what is different between payback period and ARR? Payback was used for calculating risk, right? And ARR is used to calculate the profitability, right? So it's basically focusing on return, and payback period was focusing on risk, right? The problem with payback period is, with the accounting rate of return is that it is based on profits. And of course, profits have a lot of problems, right? There is a past exam question extract. It says, explain why accounting profits may not be the best measure of the company's achievement. Explain why accounting profits may not be the best measure for the company's achievement, right? So if you want to see if the company is doing good or bad, in other words, you should not be using profitability to see or to judge if the company is doing good or bad, right? Why? What do you think? What's the reason? Anyone? So yes, the two main factors are, first of all, that the accounting profits could be manipulated, right? As we said before also, like it includes non-cash flow items such as depreciation or amortization. It depends on revenue. Revenue is not exactly cash flow, right? So for example, if you recognize the revenue in the wrong way, right, you can actually manipulate the profitability figure, right? So it can be manipulated for personal gains, like the manager may manipulate it in order to get the rewards, right, in order to get the bonus. So that's the first problem. And the second thing is it does not show you any liquidity, right? So for the homework question, I'll give you a couple of points and you have to actually make up your own answer. The first one is creative accounting, right? We can window dress our profit and loss statement because of the non-cash flow items, right? And the revenue recognition if you do it in the wrong way, for example, right? So you can talk about over here, you can talk about revenue. So the revenue can be manipulated and the cost, especially which cost? The non-cash flow one, right? Which are non-cash flow. And the second factor was that it does not show you liquidity. Right? It does not show you the liquidity position. As we said yesterday that if you have $100 of cash flows, it will be $100. But if you have a profit of $100, it does not mean that it will be a cash flow of $100 also, right? So you can actually make two headlines, and under the first headline, you can talk about the creative accounting. In creative accounting, you can say that, well, maybe with the revenue recognition, though it will be a bit difficult with the new IFRS on revenue, but still, if you recognize the revenue in the wrong way, or the non-cash flow items like depreciation or amortization, right? If you just intentionally or deliberately guess it wrong in order to make your profit figure look good, in order to get the reward, right? So you can also talk about agency. We can, in agency, we can say that, well, the director or the manager is actually doing something in his best interest rather than the best interest of the company. So the agency would mean that he will actually try to do the creative accounting in order to get the rewards. And then the second one, it does not show you the liquidity position. So under these two headlines, if like a couple of paragraphs under the first headline and then maybe one paragraph in the second one, and then in the end you can have a conclusion paragraph, right? And so in the conclusion you used to say that because of this, that's the reason that this is not the best thing to do to see the company's performance, right? It's a real past exam question, guys, right? Of course it was a long question and this was just a part of that long question. So accounting rate of return. Is the calculation difficult? Not at all. What about the other factors to consider? So what are the advantages and disadvantages? We're going to start with disadvantages first. Why? Because we have just discussed a couple of disadvantages. So the first disadvantage that we have just discussed, it ignores cash flows, right? These are advantages and disadvantages of ARR, accounting rate of return or return on capital employed. It ignores cash flows. Why? Because it is based on profits. Accountant can play with the figures. Manipulation, accountant can manipulate the figures. There is no definitive signal. This is the same like payback period, if you remember. No definitive signals, which means that target ARR is required to take decision. Like you cannot just look at the answer, okay, so this is the answer, it means accept, or this is the answer, so it means reject. No, there's no definitive signal. It depends on the company's policy or the company's target ARR, right? Using profits will include non-cash flow items such as depreciation and amortization in our calculation also. Now, these are non-cash flow items, and again, your accountant can actually play with the figures, right? He can actually manipulate the figures, right? So these are the disadvantages, and apart from that, the first disadvantage that we have seen before also in payback period, that it ignores the time value of money. It ignores the fact that this 100,000 or this 200,000 and this 200,000, they are in different time periods and they have different values. So of course, if the time period is far away from you, that means that the value will be smaller, right? Just in case if you forget, like if you have 200,000 now, and if let's say you have 200,000 after 6 years, so you can see that that will be actually looking comparatively smaller, right? So time value of money is totally ignored. Advantages. It's very easy to understand and simple as it's a percentage, right? Percentage is very easy to understand. And the other thing is, like if you see the formula of ARR, you know, why are we using the same word for ARR and return on, the accounting rate of return? Why are we using the words interchangeably? Because the reason for that is that return on capital employed is actually a very common word, and all the investors will actually understand what exactly is return on capital employed. So let's say, for example, if you have an investor and the investor is asking you what is ARR, and if you're telling him what is ARR, maybe it will be difficult for him to understand. So you can tell your investor simply that, look, it's simply return on capital employed that you already know of, but it's for the future, and that's it. And then he'll understand it, right? So even a layman can actually understand what is return on capital employed, right? So it's a very common ratio, a very common formula, and very regularly used. So it's very easy to understand. And the other thing is that you simply are looking for the profit on your capital employed, right? So how much percentage profit you can get, right? Why is the percentage actually better as compared to the absolute value, right? So if it is in dollars, that is absolute value, right? The percentage actually gives you an idea that how much is the percentage profit considering the capital employed. It means that you can actually compare two projects, right? You can easily compare two projects, right? Because they will be considering the capital employed also. Let's say, for example, you have project A with a profit 100 and project B with a profit 200. Which investment is better? So investment A has a profit of 100 and investment B has a profit of 200. Which one is better? What do you think? Well, of course, you'll say the second one is better because it's giving you more profit. But let's say the capital employed for the first one is so let's say it's 200, and for the second one is also, or for the second one is, let's say, 400. So how much is the return on capital employed? 100 by 200, right, is giving you 50%. And the second one, oh, that's also going to give you 50%. Let me change it. Let me make it 500, right? So 200 divided by 500 will give you 40%. So it is considering two factors, the profits and the capital employed. So now you can actually compare the two projects also. You can easily compare two projects, right? So it can be used for comparison. That's another advantage, right? Okay, the next one is, unlike payback period, it does not ignore profitability. Well, that's an advantage, that it is considering profit, and the disadvantage is that it's not considering cash flow. Of course, you cannot have both of them, but of course, profitability is also an important measure. And in accounting rate of return, we are considering profitability, right? Okay, so advantages and disadvantages, remember, they are actually very important for you in your exam, because normally, like if you have a long question, you may get a small explanation bit or analysis bit, or you may have to write a few words on the basis of your calculation. So make sure that you actually understand these theoretical bits also, right? It's very important for your exam. Okay, accounting rate of return or return on capital employed. Is it fine for everyone? Is it clear? Any questions? Now let's go back to chapter number 2, the end of chapter number 2. So payback period is done, accounting rate of return is done. So the basic techniques of investment appraisal are done. The next one is advanced techniques, and advanced technique will require you to understand the time value of money. The fact that money is has different values considering the time, or with the passage of time, money loses value, right? The time value of money. It's actually the end of the page. Time value of money, which says that money received today is worth more than the same sum received in the future. This is what we call time value of money, right? Now, I'll start with an example. Let's say, for example, if I want to give you $100 now, which means year zero, or $100 after 10 years, which one are you going to prefer? $100 now or $100 after 10 years? Well, there are three reasons that you will be saying that we will go for $100 now, right? You will go for $100 now because of three reasons. First of all, $100 now will worth more, and after 10 years, because of inflation, the value of $100 will be lower, right? So because of inflation, the value of $100 will be lower. So that $100 after 10 years will be maybe equal to like $50, right? The other reason is that I may not have $100 after 10 years. So you better take it now. If you will wait for 10 years, you're actually taking risk, right? And the third factor is that if you take $100 now, you may invest it somewhere and get some return or interest for the next 10 years. So because of these three reasons, you will prefer to take your $100 now. And that's what we include in time value of money, right? First one is the potential for earning interest, or what we call the cost of finance, right? Like you save some finance, for example, finance cost or the interest cost, right? So for example, if you get the $100 now, you can get some interest on this for the next 10 years, number one. The second factor is the inflation, that after 10 years, the value of $100 will be lower, right? And the third factor is the risk, that if you want to wait for 10 years, then you are actually taking risk, because I may not have $100 after 10 years, right? And because of these three factors, you will go for getting the money now. But let's say if I insist that no, I have to give you after 10 years, then maybe you would say, okay, if you want to pay after 10 years, then don't pay us $100. Maybe you can pay us $200. Why? Because I cannot get interest now. I'm going to lose the opportunity of getting interest. So we can also call it opportunity cost. Because of the inflation, the value will be lower. And because I'm taking some risk also, I don't trust you, right, for 10 years. So if I have to trust you and take the risk, then you have to give us $200. So in other words, you can say that $100 now, year zero, which means right now, is equal to $200 after 10 years. Right? Now we use a technique to calculate it. I mean, this is just a guesswork. But let's say, for example, if I'm given the $200 and if I want to calculate the value now or the present value, right? So this will be the present value. The present value is $100 and the future value is, let's say, $200. So we'll use a technique called discounting to calculate the present value of the future value. Right? This is what we call discounting. Now, if we are given the present value and if we want to calculate the future value, this is what we call compounding. So basically, we're doing the opposite. We're given the present value and we want to guess the future value. We are going to do compounding then. So on the next page, right, of course, for most of you, you'll be very comfortable with the calculation, right? Just for a couple of you who are not very comfortable, right, we'll spend a little bit time on discounting and compounding, right? So discounting, we use discounting technique to calculate the present value from the future value. From the future value, you calculate the present value. That's what we call discounting. And what's the formula? Present value is equal to future value. Can you please write it in your notes? Multiply by 1 plus r raised to the power minus n. You can also write the formula like this. Present value is equal to future value. Multiply by 1 divided by 1 plus r raised to the power n. You can actually use any of these two formulas. Both of them are perfectly fine. If you want to write minus here in the power, then you can use this. If you don't want to write minus, then you can use this. I personally prefer the first one, right? So in this formula, of course, n is the number of years. So if in the previous example, we were saying that the value was 200 after 10 years, so the value of n will be 10. R is the discount rate. What exactly is the discount rate, right? We are going to learn it in chapter number 4. But for right now, the discount rate actually helps us to calculate the present value, right? What exactly should be the discount rate, that we will learn in chapter number 4, right? So let's do the calculation right now. So we have question 2.7. It says, right, I'll do a couple of them and then you'll do a couple of them and then the rest of them will be actually your homework. So future value is 10,000 in 10 years time and the discount rate is 10%, right? So after 10 years, if the future value is 1,000, then what is the present value, right? We have to find the present value, right? So we are actually doing discounting. So question 2.7, number 1. Let's write down the formula. Present value is equal to future value multiply by 1 plus r raised to the power minus n. We have to find the present value and we said after 10 years the value is $1,000. How much is the discount rate? The discount rate is 10% and number of years are also 10%. So let's write down the discount rate. Okay, so I can write 1 plus 10%, but instead of 1 plus 10%, I'll actually write 1.10 because 10% is 0.10. So 1.10 raised to the power minus 10. Now, even if you're comfortable with the calculation, I would like you guys to be doing it very, very slowly along with me in the calculator. We will do it in 2 steps and you also do it in 2 steps for some reasons. So present value is equal to $1,000 and what do you get from this? So it will be 1.10 and for raised to the power in your calculator is going to be either this sign or maybe it's like the opposite V sign, upside down V, right? So it will be either like this sign or it will be this sign, right? So 1.10 raised to the power, and the bracket has opened automatically. If it doesn't open automatically, please do open it manually. Minus 10. 1.10 raised to the power minus 10. Please don't try to do it before me. 0.385543. We'll actually write it up to 3 decimal places. So it will be 0.386. So the present value is 386, right? Now, I know that most of you are actually very comfortable with the calculation, but for some reasons, I'm saying again and again, right? Do it with me, don't do it before me, right? And maybe you will get it later on that why did I say it? Okay, so what does that mean? That $1,000 after 10 years, in current terms, in today's term, that is actually equal to $386. So if I tell you that I can give you $386 now or after 10 years, you would say, well, if you want to give us after 10 years, then give us $1,000. Because 10,000 after 1,000 after 10 years will be equal to $386 now, right? That's the first calculation, right? If there is any confusion, do let me know. Otherwise, if you can do the second one, right? 250 is the future value in 5 years time, and the discount rate is 7.5%. So what is the value? Can you do the calculation for me, please? So it's very easy, right? I mean, you can actually do it in one go, but I'll prefer to do it in steps. Let's do the third one now. 14,000 in 7 years time, and the discount rate is 16%. 14,000 in 7 years time, and the discount rate is 16%. The answer for this one will be 4950, 4954. And the third one, we are expecting 6,000 after 3 years, and the discount rate is 9%. This should have an answer of 4633. Can you please confirm if you guys are getting the right answers or not? We'll do the fifth and the sixth together, right? Are you guys getting the right answer or not? Let's quickly do the third one and the fourth one together. So the third one, 14,000 in 7 years time, and the discount rate is 16%. So number 3, future value, 14,000 multiplied by 1 plus R, and the discount rate is 16%, so it will be 1 plus 16%. How many years? 7 years, so minus 7, right? Make sure you write the minus sign, guys. Make sure you write the minus sign. And again, I want to keep it separate, right? Keep it separate. 1.16 raised to the power minus 7. What do you get? 1.16 raised to the power minus 7. What do you get? It's 0.354. So the present value will be 5954. Sorry, 4954. And similarly, the fourth one, the fourth question is saying that you get 6,000 after 3 years, and the discount rate is 9%. So again, present value is equal to 6,000. That is after 3 years, so minus 3. And the discount rate is 6%, so 1 plus 6%. So the present value will be, again, I'm saying, guys, do it in 2 steps, please. 1.06 raised to the power minus 3. That will be 0.839 or 0.840, right, if you round it. So the present value will be 5037. Did I do something wrong? It's, I think, not 6%. I think it's, yes, it's not 6%. It's actually 9%. It's actually 9%. So this value is going to change. So 1.09 raised to the power minus 3. What do you get? 0.772. And then you multiply it with 6,000. So what do you get? 4633. Right? So 4633. Is everyone fine with the calculation now? Right? Is it clear? So question 3 and 4, it was about discounting. Let's see the fifth one. The fifth one is saying we are expecting 9,000 from year 1 to 4, which means 9,000 in year 1, 9,000 in year 2, 9,000 in year 3, and 9,000 in year 4. So you have now 4 years. And for all those 4 years, you have to calculate the present value, right? Discount rate is 2%, right? Now, in order to do it, actually, I'll slightly change the format. I'll write years here, 1, 2, 3, and 4. I'll write the future value, 9,000 in year 1, 9,000 in year 2, 9,000 in year 3, 9,000 in year 4. And then I multiplied with 1 plus r raised to the power minus n. So 1 plus r raised to the power minus n. And that will give you the present value. Of course, we can see that present value is equal to future value multiplied by 1 plus r raised to the power minus n. So present value is equal to future value multiplied by 1 plus r raised to the power minus n. And this will give us the present values for all the years. So now 1 plus r, what is the value of r? The value of r in this question is 2%. So 1 plus 2% raised to the power minus 1, 1 plus 2% raised to the power minus 2. So that will be 1.02 raised to the power minus 1, 1.02 raised to the power minus 2, 1.02 raised to the power minus 3, 1.02 raised to the power minus 4. So what do you get from 1.02 raised to the power minus 1? It's 0.980, and then you multiply it with 9,000. So what's the present value? 8823 or 8824. Or for example, the second one, 1.02 raised to the power minus 2 now. What do you get? 0.961. You multiply it with 9,000. What do you get? 8651. The third one, 1.02 raised to the power minus 3 multiplied by 9,000 will give you 8481. This will be 8315, the fourth year. Right? Are you all getting the right answer? Let me double check my answers. So 8824, 8651, 8481, and 8315. If your answers are slightly different, that will be because of the rounding, right? So if you have 9,000 after 1 year, the value now currently in year 0 will be 8824. If you have 9,000 after 2 years, the current value, today's term, the value will be 8651. If you have 9,000 after 3 years, the current value will be this much. If you have 9,000 after 4 years, the current value will be this much. And can you see, all of them are 9,000, but the current value keeps on decreasing, right? With the time period, the current value of all of them are actually reducing. So if you have a total of 36,000 future value, so the total present value will be, if you can add all of them, 8824 plus 8651 plus 8481 plus 8315, that will be 34,271. So what does that mean? For the overall future value of 36,000, the overall present value will be 34,271, right? 8315, yes, this is also 8315. I'm getting the same answer. 8314, 8315, that's because of the rounding. Okay, why are we doing it separately? For some reasons that I'll tell you in a while, right? Maybe you would know something more than the others and that's why you're asking it. But present value of this 9,000, present value of this 9,000, this 9,000 and this 9,000 are here. And the total present value is this, right? Okay, let's see the next one. We are expecting 4,500 from today, and today means year 0. So 4,500 from today to year 6. So how many years are there? There are 7 years now. Year 0, year 1, 2, 3, 4, 5, 6. So there are 7 years in total now. Discount rate is 5%, right? So now you are going to help me with this. So number 6, year 0, 1, 2, 3, 4, 5, 6. The future values are 4,500. In year 0, 4,500, 4,500, 4,500, 4,500, 4,500, 4,500. Multiplied with 1 plus r. I'll actually write the value of r. What is the value of r? R in this question is 5%. So instead of 1 plus r, I'll say 1.05 or 1 plus 5%. Raised to the power minus n. So every year is going to be different. And this will actually give you the present value, right? Now I have a question for you guys, for which maybe you have already given me the answer. And the question is that I have this pencil, and the value of this pencil now is $1. The value of this pencil now is $1. So what will be the value now? If the value of this pencil now is $1, what will be the value now? Of course, it will be $1, right? Because that's already in present value term. So for year 0, which is already in present value, you'll have the same present value. The future value is already in present value term because that is year 0. So the present value will be 4,500. How do you get 4,500? When you multiply it with 1. If you want to be very mechanical and you actually want to calculate it through the formula, of course you can do it and it will give you the same answer. So 1.05 raised to the power minus 0, which will be equal to 1, right? So for year 0, it's always going to be 1, right? Now, I'll give you the answers. I'll not give you the answers actually. I'll give you 2 minutes if you can quickly calculate it for me. Right? Let's see who is going to do it first. Let's see who is going to do it first. Come on, everyone. Don't look at my answer because I can actually copy it. So my answers will be slightly different than yours because of the rounding. So the total future value and the total present value. Now guys, the next question is your homework. And when I give you the answer for those for which the answer is more than 1 year, so of course I'll give you the total present value, right? And then of course you have to do it in your own time. So 2.8 is actually a similar question, and that's your homework question. The answer for the first one is 4564. The answer for the second one is 4.3 million. The answer for the third one is 27738. The answer for the fourth one is 17427. And the answer for the last one is 44550. So can you see the last two one, especially the last two one or the last three one, right? It's actually for more than 1 year, and I've given you the answer in total. So you have to actually calculate it individually. Now we will do something opposite of discounting, right? And the opposite of discounting is what we call compounding, right? Now, what is compounding? Compounding is quite similar to discounting, quite similar. I mean, the calculation is going to be almost the same. There is only a slight difference. Can you see? Compounding, we use compounding technique to calculate the future value from the present value. So what's the formula? Future value is equal to present value, and then you multiply it with 1 plus r raised to the power n. You will not have the minus sign, and that's it. That's the difference, right? Rest, everything is the same. So, question 2.9, which is actually the homework, and it says recalculate the future value from the answers of the present value of question 2.8 and add something 2.7. So what does that mean, right? You see, we have calculated the present value already from the future value. The present value from the first one was, I think, 386 or something. Yes, 386. So what will we do now? We will say that we have 386, which is the present value. Discount rate is 10%. And we have to calculate the future value after 10 years. So if your answer is 1000, it means you are calculating it correctly, right? So I'll do the first one, question 2.9. which is recalculate question 2.7, number 1. So the formula is, now we have to calculate the future value. So future value is equal to present value multiplied by 1 plus r raised to the power n. So future value we need to calculate now, and the present value, we said we calculated it, it was 386. So when you multiply it with 1 plus r is in the question, I would say 10%, I guess. Yes, 10% and 10 years. So 1.10 raised to the power 10. So are you getting 1000 or not? Well, it's not going to be exactly 1000, but it will be very close to 1000. So you see, um, so you see it's 1001 point something. Why is it different? Because of the rounding. So the calculation is correct, but it's because of the rounding, right? Similarly, the next one, you have to do it separately, right? But there is one hint that you need to be very careful about, right? Remember it, because that's very common question, and I remember that almost in every class student will ask this when they do their homework. And that is that when you have more than 1 year, so how do you calculate it? Well, of course, the present value, you convert that into future value. This present value will be converted into future value. This present value will be converted into future value. This present value will be converted into future value. And for all of the time, you should be getting 9,000, 9,000, 9,000, and 9,000 separately. And then the total will be 36,000. Right? So be very careful with that. When you have more than 1 year, you have to do it separately. For all of them, you have to do it separately. So the homework is that this 2.7 and this 2.8 question, you have to do it again for compounding to get the answer what is actually given in the question. So if you do the second one, your answer should be 250. If you do the third one, your answer should be 14,000. If you do the fourth one, your answer should be 6,000 per year. Right? No, so it's not per year, it's for the third year. If you do the fifth one, it should be 9,000 for every year. For the sixth one, it should be 4,500 for every year, right? So discounting and compounding wasn't difficult at all, but something which you are going to see it in your exam, right? We have done it using the formula, right? We are going to see something different now, and that's the reason I was asking you guys to do it in steps, right? Can you see this figure here? Or maybe I'm going to use, I don't know, I'm going to use, okay, this highlighter, right? So you have the discount rate of 10% after 10 years, and the value is 0.386. When you have a discount rate of 16% after 7 years, you have 0.357. I wanted to do it separately in steps rather than multiplying it directly in one step. Of course, you can skip the step and directly calculate this answer. But what's the reason I was asking you to do it in steps? Because these values of discounting, you can actually see in a table which will be given to you in the exam, and that's what we call present value table. This present value table will be given to you in the exam. Why didn't I show you the table first? Because I wanted you to be comfortable with the calculator before we actually use the table. And trust me, in your exam, if you are comfortable with the calculator and your spreadsheet, it's actually easier to do it on the spreadsheet rather than looking for the figures in the table, right? So what was the formula? Present value is equal to future value multiplied by 1 plus r raised to the power minus n. Now the value of 1 plus r raised to the power minus n, all these values are actually given in here, right? And you are given the values up to 15 years and up to 20%, right? For example, let's say if I say that the discount factor at the rate of 10% and the number of years is, let's say, 10 years, our first question. So you have 10 years, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then you have 10% over here. So the value will be 0.386. If you want to use it in the calculator, you can do it 1 plus 10% raised to the power minus 10, which will give you 0.386. That's the reason I was rounding it up to 3 decimal places, because the table that you're going to get it will also be rounded up to 3 decimal places. Let's say, for example, we have discount factor at the rate of 5% and the number of years are 7 years. So you'll have 5%. sorry, 5 years, sorry, 7 years and 5%. So the value will be 0.711. If you want to do it in the calculator, of course, you're going to get exactly the same answer. Let's do it the third time, right? Let's say if it is 15 years at the rate 3%, so it should be 0.642. So for example, it will be 1.03, 1 plus 3% raised to the power minus 15. So you're going to get 0.641 or rounded 0.642, right? So these values, you can actually get it from the discount table, and the discount table will be given to you in the exam. Now, but the issue with this is, with one of the question, if you remember, the discount rate was 7.5%. The second one, the discount rate was 7.5%, right? So if it is, let's say, 7.5%, so let's say the discount factor at the rate 7.5%, and the number of years are, let's say, anything, let's say 4, right? Now you don't have 7.5%. So what you can do in your exam, first of all, it's 4 years and 7.5%. You can either take this value, or you can use this value, or you can actually calculate it exactly somewhere in the middle for 7.5%. For 7.5% year 4, the exact value will be 1 plus 7.5%, which means 1.075 raised to the power 4. So what do you get? Sorry, minus 4. So what do you get? 0.748. 0.748. So that is actually for 7.5%. 0.748, right? Which is none of these two, right? Which is none of these two, right? So 1.075 raised to the power 4, so minus 4, will be 0.749, right? Which is actually none of these two. So if you want your answer to be accurate, then maybe you can use your calculator, but you are not going to get the help from the table now, right? Similarly, let's say if the discount percentage is, let's say, more than 20%, for which the chances are actually very, very, very low, then you can use the calculator. Or let's say if it is more than 15 years, then you can again use the calculator. So you should be equally good with the calculator, and you should be equally good with was it 5%? Okay, yes, you're right. This is not for the 4th year. The 4th year values are in here, right? Right. So 7.4%, 7.49%, 0.749% is actually for 7.5%, right? So sorry, 0.749 is actually 7.5% for the discount rate of 7.5% for year 4, right? And that's not 4 years or 7 years or 10 years. That's the 4th year or the 7th year or the 10th year or the 15th year. That's 1 year. Remember that, right? That's 1 year, right? So you have learned discounting. You have learned how to calculate it using. So you have learned discounting using the formula. And you have learned discounting using the table, right? Again, you can actually calculate using the table also, all the same figures. So what is the homework? The homework is, of course, if you can see, find the present value using the discounting formula and the discounting table. So of course, you should be very comfortable with both of them. Now, please don't ignore it. You might be thinking that, well, these are easy questions and yes, I can do it. It's not an issue. Trust me, this is something very basic that is definitely going to be tested in your exam. Definitely, it will be tested in your exam. So make sure you're comfortable with it. Make sure you do it using the formula, using the table. You do the compounding, you do the discounting also, right? So you have to do the opposite of all of them, right? Now, this is discounting and compounding, right? Now, I'll actually take you to the spreadsheet once again, right? And I want to do the discounting in the spreadsheet, right? By the way, there is no table for compounding, so you don't have to worry for compounding tables. Of course, you can ignore that. But you see, on the spreadsheet, it's actually going to be very, very easy, right? So, discounting. Right? Now, I'll actually write years. Let's say if I write from year 0, 1, 2, 3, 4, 5, 6, and 7. And let's say my discount rate is so discount factor at the rate of, let's say, 5%, right? 5%. So what I can do is maybe I can write 5% here, and then I can write it in the spreadsheet like this. And I think, watch it very carefully, right? You see, what was the formula? 1 plus r raised to the power minus n. So I'll start with equal sign because all the formulas in spreadsheet will start from equal. So is equal to bracket 1 plus 5%, close the bracket, and then for raised to the power, it's shift 6. Raised to the power minus, and then I can write minus 0. But instead of writing 0, what I can do is I can actually link it with this cell. And I'll press enter. So I'll get 1. Why did I do it? Right? I'll do it once again and then I'll tell you why did I do it. So 1 plus 5%. So I can say 1 plus 5%. And of course I have to close that in the bracket. And then shift 6, which means raised to the power, and then minus sign, and then I can write either 0, but instead of writing 0, I can actually link it with this 0 and enter. So what do I get? 1. But you see, when you get to the formula, when you write the first formula, you simply have to drag it and apply the formula on all the cells, right? So it's 5% year 1, 2, 3, 4, 5, 6, 7, right? Because if you can see the first one, right, year 1, it says 1 plus 5% raised to the power 1. If you see this one, it's 1 plus 5% raised to the power minus 4. So rather than writing 4, we can actually link it with the cell, and it can actually make our life very easy. Now, if you link it with the discounting table, right, or if you compare it with the discounting table, where's my pen gone? Okay, so in the table, it was 5% year 1, 2, 3, 4, 5. There's 5% year 1, 2, sorry, not this table, this one, it's another table. 5% year 1, 2, 3, 4, 5, 6, 7. All these values Excel has calculated it for us. Let's say, for example, let's check it for the 4th year, it's 0.823. Do you get 0.823 for the 4th year? We are not actually. Are we doing something wrong? Yes, I think we are doing something wrong. Let's double check it. Did we put minus sign? Hold on a second. Let me do it once again. So if you can see now, you actually have to press F4 when you link it with the 5%. So it will be is equal to 1 plus 5% and then press F4. When you press F4, it will make it the exact this value, which is 5%. And then close the bracket, raise to the power minus, and then you can click on year 0, right? And it will give you the same value. If you don't want to press F4, right, then what you can do is, if you have 5% here, rather than linking it, what you can do is you can say, well, is equal to 1.05, which is 1 plus 5%, raised to the power minus 0. And that will be even enough, right? If you don't want to link it, so it will be 1 plus 5% or 1.05 raised to the power minus 0, and then drag it and apply it on the rest of the cells. Can you see? These are the values. These are the exact values that you're going to get in your table also. They are not rounded for 3 decimal places. If you want, you can round it. You'll have this option in your exam, right? You see these zeros, right? The decimal places, you can round it. But I would say you should not waste any time in the exam in rounding these figures, because the presentation will have no marks. So I would say that if it is in 4 or 5 or 6 decimal places, whatever they are, right, you just leave it like this, right? It will be looking awkward, but it doesn't matter at all. You're not going to get any extra marks for rounding, right? So this is how you do it. I'll do it once again. Let's say this time I'll do it for 10%, right? So is equal to 1 plus 10% or 1.10 raised to the power minus 0, and then you apply it on the rest of the cells simply, right? And that's the reason that I told you that, well, maybe looking or picking up all the figures from the table will be a bit difficult for you, but if you can do it like this, so of course it will be easier. Another way to do it will be like this. If you just want to learn another way. So let me do it for 5% once again. First of all, for year 0, you would say it's 1. For year 0, it will be 1. So you don't have to calculate it. And for the next year, you would say the previous year divided by 5%. So the previous year figure divided by 1 plus 5%, sorry. Previous year divided by 1 plus 5%, so 1.05, right? So previous year divided by 1.05 or 1 plus R, and then you apply it on the rest of the cells. You see, you're exactly getting the same answer as above. Similarly, for 10%, you can say that for year 0, the value is 1, and from year 1, it will be the previous year divided by 1 plus R or 1 plus 10%, and then you apply it on the rest of the cells. Easy, isn't it? Right? You guys want to try it yourself, right? I'll give you a couple of minutes. You try it yourself, right? Try all these values in spreadsheet. Yes, so that's how you do it. That's how you do it in Excel, right? Or your exam spreadsheet, right? Just one last thing, and that is that, is there any short way of calculating this, right? Well, sometimes, yes, you'll have the opportunity, right? Like, for example, the long questions, can you see that? Let's say number 6, question number 6. Well, this is 1 plus R raised to the power minus N. So for the first one, for example, if you want to calculate, for the first one, or let's say for year 1, it will be 1.5%, 1.05 raised to the power minus 1. So what did you get? 0.952. Similarly, if you do 1.05 raised to the power minus 2, 1.05 raised to the power minus 3, it will give you these figures. But there is a shortcut to calculate it even in your calculator. So let's say, for example, the first one you have calculated 0.952. So what are you going to do next? This figure divided by 1 plus R. So that will be 0.952 divided by 1 plus R, which is 1.05. And this will give you the next year discounting figure. Now this figure divided by 1 plus R will give you the next year's figure. This figure divided by 1 plus R will give you the next year figure. This figure divided by 1 plus R will give you the next year figure. And the last one divided by 1 plus R will give you the next year figure. So that's actually the shortcut. And in Excel, in the last one, when we were doing it, we actually used the same principle. Can you see? The previous figure divided by 1 plus R. Similarly over here, the previous year divided by 1 plus R. The previous year divided by 1 plus R. The previous year divided by 1 plus R. Right? So we actually are using that shortcut that you can use in your calculator also. Right? Now that's all about discounting and compounding. I would like you guys to be very comfortable with discounting and compounding. Make sure you do each and every question. Now I'll actually increase it to do it using the discounting formula, discounting table, and then spreadsheet. So you do all the calculation in discounting and the compounding, and in discounting and compounding using the formula, using your table, using your spreadsheet, right? This will at least take at least a couple of hours if you do all of them. And of course, you should be doing all of them. The reason for spending so much time on this simple topic is because it will be tested in your exam, right? It will be definitely tested in your exam, right? Okay, this will be it for today, right? Thank you very much, everyone. If you have any question, do let me know, right? If you don't have any question, then you can actually just do the homework, and this would be it for today, right?